Hey everybody, Steve Olson here with the Peak Group. I wanted to take a minute today to talk about kind of what we've been seeing in the market. I remember going back to, I think it was early 2022. I might be slightly off, when interest rates really started to kind of creep up. And I noticed there was a lot of activity in the market for about 6 months after that. You kind of get these 1031 exchanges bleeding out and needing to close. But after that, in residential real estate investment, the market got very, very slow because prices had not adjusted, and I would argue they still probably haven't. Interest rates kept going up and up, and it was just a deer in the headlights effect on the residential real estate investor. And so I get asked a lot about, what's going on out there. I wonder a lot about what's going on out there, but we do have a lot of conversations with investors and other developers and builders and property managers and lenders and all these pieces that go into the puzzle. So I took some notes here. I hope you don't mind. I'll refer to my iPad throughout the episode, but a few thoughts on what I've seen. So far, the residential market is still pretty resilient. Now, that, of course, depends on the metro. We've got over 400 different metropolitan areas in the U.S. And so financing is completely overarching all of those. And financing obviously impacts residential real estate investment. The local market dynamics do too. And so it's pretty resilient. Although we're seeing inventory creep up a little bit, I continue to see builders be the ones that are doing volume and selling properties, while the resale market tends to struggle a little bit. Homes stay on the market for a lot longer, and people usually have to do some cuts. And once again, this is a general explanation. I don't need I don't need emails coming in about, hey, my market in Tupelo, Mississippi isn't like that at all. I'm just generally speaking here, okay? Sorry to pick on Tupelo. Interest rates seem to be stabilizing. I am sensing that the investor, the market is, and sentiment is very real, okay, on how it impacts investment. But I'm sensing that people feel like the worst is over on that front. Interest rates could certainly go up, but we're continuing to see that closure between the spread on the 10-year Treasury and mortgage rates. As I record this, the 10-year is at 4.1 and change. So just a lot of fear. What's going to happen with tariffs and Trump and everything? It seems to be settling down a little bit. But even that being said, it hasn't brought the market to equilibrium. So rates have come down a little, but it hasn't lit the market on fire. That's a metaphor in a good way, where people are really coming out and buying. They're still cautious on that front. They say, hey, home values are steady. And for example, fourplexes, though, properties that are income dependent, fourplexes and duplexes, unless it's being purchased by an owner occupant who's going to house hack, I've actually seen prices come off about 15% or more. That's just what it takes. I sold a fourplex earlier this week. When it went on the market, I thought we could get about $1.3 million for it. We ended up taking a little over 1.1 for that property. That's just what it took for somebody to come out and buy this thing. So will the market crash? Well, we just don't know. Inventory is still really, really low. A lot of people aren't anxious to sell. They're locked in by those low rates, and there's just not a lot happening. But I am starting to kind of see the first rumblings of people moving past that. There was a lot of talk of the lock-in effect. I've got a low mortgage rate. I'm never leaving. Well, guess what? Sometimes life doesn't care about your low mortgage rate, and life will catch up to a lot of people. Eventually, you get that new job. There's some change in your life that makes it so you just don't have a choice. And I'm starting to see a little bit of that happening, where people say, this rate is nice, but life happened. And life will continue to happen, so we'll probably see a gradual return to some market activity as life inevitably continues to happen for people. Mortgage rates are, 6.5 to 7.5 for owner occupants. I was talking to JT, who we had on the show recently, and he quoted on one of our build-to-rent properties in Alabama, if somebody contributed 2 points, they got down to the low sixes on that interest rate. So you can buy those rates down. You can try to engineer this stuff. You get into the low sixes. That was on a single family home. And of course, if you put 30% down instead of 25, or on a single, if you put 25 instead of 20, you do continue to see more savings on your rate. Creative financing is taking a big role. More and more people are looking at debt service coverage loans. More and more people are looking at assumable loans. Anything they can do to try to game that system with interest rates. Investors are putting a lot of emphasis on cash flow over appreciation. There seems to be a feeling that, well, I think that the market is topped out and maybe it's going to go down a little, maybe it's going to go up a little, but it's probably just going to kind of hang out, for lack of a better term. So if I'm going to do something, I'm going to do something that has some cash flow to it. I remember in 2021, people didn't really care about that. It was just hey, you got real estate, I want it, right? Nobody was thinking. Now they're thinking a lot more. I actually think that's a good thing. What about property management and rentals? I've seen the leasing market pick up pretty well where we operate in multiple projects over the last 60 days. And I think some of that is coming out of Thanksgiving and Christmas. The market does tend to slow down that time of year. You don't want to move during Christmas, and neither do I, right? Tenants are no exception. But now things are warming up. People are getting back into life, and a little bit of that household formation is starting again. You know, I've got a 76 unit build for rent townhome project I'm doing right now. And we started the year, I think we had 25 vacant units. We just kind of plodded along with one lease per week through January. And then in February, the market woke up. We were knocking out 4 or 5 leases a week. We're leased up now. We're stabilized. So what was really interesting, and I am still scratching my head on this one, and if anyone has an answer for me, I'd love it. But when the mortgage rates really started to accelerate a couple of years ago, I was of the belief that this is going to make rents grow. It's going to take some time, but this is forcing people out of the home buying market, and it's creating more tenants. It might now be doing that. We don't know, right? Rental markets move very slowly. Leases take time to expire. All that stuff has to come out in the wash. But what I didn't see was a raise in interest or in leasing activity and rents. In fact, it just backed off. This inflation shock that people felt, I used this phrase earlier in the show, was a deer in the headlights, and people just stopped moving. They were cramming other people in their units. They were renewing leases, but they were just not moving. And I think that that rental rate growth is slowing, but I think it's probably about where it's going to be now, because, you know, it's starting to feel these effects of builders not putting up as many houses. We're absorbing gradually some of that COVID inventory. So it'll be interesting to see what happens to rents throughout 2025. I get asked about short-term rentals a lot. We don't do that, but they're continuing to face regulation. I had an investor get really interested in that the other day. And, you know, I'm not an expert in short-term rentals. All I'm going to say is that it's a hot button topic, and it is easy for local cities and municipalities to get angry and to pass laws that can make it tough for you to operate a short-term rental. And that's something that's just so hyper specific to your locality that's where I would be researching that. So build to rent is still going, and it's attracting more and more capital as a lot more people in the US think that home ownership is not for them. And so institutions are delivering more build to rent, but not like they used to, because it's just a lot harder to pencil. I told somebody yesterday in a conversation, I have looked at so many deals in the last 2 years that don't pencil even if you get the land for free. This is income, expenses, and interest rates. We have not seen enough relief in land prices. I don't think that that's possible. And we've not seen enough relief in building prices to offset that stuff. So the Sun Belt is still kicking butt. There are some markets where there's a lot of inventory, but the population does continue to grow. And most people feel like that's a short to intermediate term problem that gradually will return to those being desirable places to live, and that inventory will absorb. And I also think it's the Midwest's time to shine. The Midwest has been neglected for a long time. I've been working on my own development in Indiana. We're getting a lot of activity. People are really interested in the Midwest. So that's just a little bit of what I've been seeing in the market out there and what investors are thinking about. There's a lot of cash on the sidelines, but it's kind of slowly poking its head out saying, okay, have we seen all this uncertainty begin to pass us, and can we move on? Time will tell. Thanks for joining. We'll catch you on the next episode.